All right, so hello and welcome to the Assay TV. Today, I am really pleased to be joined in the one-to-one offices with William Hess and Song Gao, both co-CEOs and heads of research at PRC Macro. So thanks for joining me here today.
Right.
And so maybe you can just kick off telling us a little bit about PRC Macro and both of your roles there.
Sure. PRC Macro is a China-focused advisory firm. We work with hedge funds, large institutional managers, I think increasingly with mining companies and mineral companies to better understand what's happening on the policy front in China and what that means for asset prices across asset classes.
Sounds great. And so geopolitics is a major issue in the metals and mining industry today, and probably most industries, with US-China tensions being a key concern. So how do you see the new Trump presidency, tariffs, everything that's coming with that impacting the industry, both domestically in China as well as with kind of China's global relationships?
Overall, I think our framework is that we see structural increase to resource demand. Countries are going to be building out their own systems. For example, the EU is going to be building out its own national defense capacity. The US wants to build industry. So each geography seems to want to take on these very large priorities, which are fundamentally good for resource demand. So I think we're going to see a structural increase to the commodity demand and competition for commodity resources globally.
Absolutely. And do you see, I think that's really going to impact like the whole metals value chains as everyone kind of keeps their metals kind of more domestic. So do you see any potential kind of negative impacts coming out of that?
Well, I think when people think about the U.S. tariffs on metals, people worry about in the longer term that will affect demand. Right? But for now, what we really saw is that it's really affecting the supply side because we can see a direct evidence that global supply disruption caused by the tariffs. People worry about supply shortage in a certain part of the world, which is basically sucking in inventory, for example, in the copper case, sucking in inventory from London, Shanghai, and Singapore. That's, yes, that will fit into the US energy security mandates, but also that created a supply shortage, outside the US. Under a typical free trade world, will never have this kind of imbalance of the supply and demand of key metals. So I think really the tariff at this point is mostly a supply disruption. Of course, I think that down the road, what's really interesting is that like Will mentioned, when we look at this world, especially with the tariff, the biggest difference is that everyone will have to have their own set of energy supply, which is a security. They have to have their own set of manufacturer base. They have to create their own set of a market. And they also need to create their own set of a defense system. So in the past, under a free trade world, we only need one set of system to fit all demand. If it's good, if it's a better manufacturer, solar panel in China, then let's build power plants in China. That's manufacture solar panel in China. And where the financing come from? The US, European Union, and Japan, they are capital abundant. So they're supposed to finance all the manufacturing in China that will create demand in global south. But now this is, I think the biggest impacts from tariff is not exactly because of tariff. It's because this kind of natural resources nationalism, this kind of elevated concerns about national security or anxiety about national security. So in that case, we need three different sets of systems with a separate energy supply, with separate manufacturing base, with separate demand market, local demand market, with a separate set of defense system. So this is a world that no longer reward efficiency and a profit maximization. This is world reward redundancy, which is, I think this will naturally create overcapacity in the downstream sector, especially for energy intensive products. But it is the great story about upstream metal demand, because in the downstream, if people have to keep overcapacity or redundancy, in the name of national security, then they will just create more, 3 times more demand for metal in the upstream. So of course, then I think people will worry about potential suppression of demand because of tariff, higher cost, higher prices. But again, I think in the past we saw Chinese government subsidizing their own metal industry or their own manufacturer base or energy intensive manufacturer. Starting from this point, we're going to see the US, European Union, Japan, South Korea, everyone will try to subsidize their own manufacturing base. I think in that case, concern about potential suppression of metal demand, has been overplayed. So yeah, I think tariff is mostly about creating redundancy, which is very constructive for metal demand in the long run. At the same time, I think it will create overcapacity in downstream for manufacture of anything energy intensive across the world.
Do you think this kind of nationalization of critical minerals is going to impact the pace of the energy transition, as there's so much more demand domestically for these key critical minerals?
I would say yes and no. I mean, I think big picture, we have a framework in mind where we have one system that's running on the dollar and fossil fuels, and the other one which is going to be running on RMB and renewable energy. So I think the energy transition is going to take a pause in Europe and the US. It's going to backtrack a little bit. China is going to continue to advance exports and investment in renewables because they have a competitive advantage in manufacturing. So I think the pace of the transition towards renewables will shift. But as Song mentioned, we're going to see a lot of other sources of demand kind of step up and pick up the slack. Where it comes to critical materials, every country has its own list, almost every country. And some of that is related to energy transition. Some of that's national defense, building missile systems and the key metals needed for products like that. So I would say it's going beyond just the energy transition to focusing on security, and the Song mentioned redundancy, to make sure you have available supply at much higher cost.
Defense seems to be coming up now as one of the kind of emerging new key drivers for metals. Are you seeing that as well?
For us, not directly. I mean, focusing on major commodities, on aluminum and copper, that's tied to manufacturing. CapEx is tied to energy investment and power grid investment, and that's really related to power is a new form of currency really, and that requires a lot of infrastructure. So far we're seeing very strong demand and projections of demand based on those needs. But so far, national defense, I think uses are relatively small, but focusing on things like power grids, on shipbuilding, that has very clear implications for major metals that we look at.
And so shifting over to China. So China had a slower than expected post-COVID recovery, and that really impacted the metals demand globally, but as well as in China. So, where do you see China's recovery and economic growth sitting now in 2025? And, how do you see this impacting demand for key infrastructure related metals?
Well, that's a very interesting question because the biggest puzzle we saw in the market is that, China's property market has lost half the size of demand in the last 30 years. But we'll look at China's demand for metals, steel, iron ore, copper, alumina. None of those demand has actually fallen that much. I mean, basically, they're not only they did not fall, they actually has increased, right? I think that is really the billion-dollar question is that how come China lost 50% is metal demand from public markets, but at the same time they're actually adding more demand for metals. That's come down to a very, very interesting observation from our side. I think has been consistently overlooked or underappreciated by the market consensus that we'll look at since 2020 until this year, China has begun to invest massively in the upstream power generation sector. We'll look at newly added power generation capacity in China since 2020. China has actually added 70% more power generation capacity in the upstream of energy sector. Right. So those increase has partially offset the slackness from Chinese property market demand for metal. Now, when it comes down to a more critical question that then we saw a major mismatch in this Chinese energy drive. By the way, I think this Chinese energy investment is one of the largest in the history. It is on par with the US shale gas revolution, which is turned China into a net energy importer, into a net energy exporter within 4 years. So now the biggest mismatch following this energy investment is that Well, look at the upstream power plant investment. We have been growing 70% in the last 4 years, right? But when we look at what happens with Chinese power grid, 2023, Chinese power grid investment only increased by 5%. First half of 2024, Chinese power grid investment was also in single digits growth. Of course, second half last year, Chinese power grid wrapped up. But you see a huge gap between how much Chinese has built up in the upstream power generation sector, but how much Chinese is behind with building up power grid connecting those power plants. So in the next this is one great example is that when we look at Chinese power grid investment or the budget for Chinese state grid company, before last year, they were only investing 500 billion every year. Last year was the first year that they budgeted only 500 billion at the beginning of the year, but by the end of the year, they actually spent it over 600 billion on power grid investment. So I think there's still 3-5 years, a major to catch up for Chinese state grid company to really connect all the newly added power generation assets in the last 4 years with the power grid. So they need to connect them to the end users. So that's why we see this is a great story about power grid investment in China.
And is that really the biggest driver for China at the moment?
Oh, well, yes. I would say if we have to pay attention about Chinese growth story, I think energy, that is the key word. Okay. Also, there's another great, very interesting story about Chinese growth is, when Chinese invest so much in energy sector, of course, don't create an overcapacity in manufacture of anything energy intensive, right? And we need to create demand. For example, if you look at the Chinese manufacture excavators versus Chinese export of excavators, you see before year 2023, only 10% of Chinese excavators manufactured domestically were actually used for exports. But 2023, 2024, almost 100% of Chinese excavators manufactured domestically were actually used for exports. So the question is this: when we look at metal demand in China, it's no longer about Chinese domestic incremental demand. It's about how much demand Chinese has been financing overseas. So the overseas demand, not financed by American companies or European companies with US dollars, is actually project overseas financed by Chinese companies with cheap RMB loans. Those are creating incremental demand outside China for global metal demand, especially for the imports of Chinese energy intensive products.
And so, China has been, I would say, years ahead of the rest of the world when it comes to electrification, EVs, other kind of key emerging technologies. So do you see this continuing to be a core focus for the economy?
Well, I think it's certainly an area of a demonstrated advantage where it comes to not just the final product of the EVs, but the whole supply chain, starting with the main sources of cost and value, but the batteries and the rest of the systems. So yes, I think this is something where China likes the auto sector. Historically, the auto sector and exports of autos is a demonstration of power and the sophistication in manufacturing. I think that's gonna be a long-term story. Whether it's EVs, whether there's more room for hybrids and plug-in EVs to maybe take some of the space that might have been EVs, that's up for debate. But I think long story short is that the auto sector is going to be one where China has a demonstrated advantage, has a very complete supply chain, and I think that's going to be a very compelling export story going forward.
I saw in the news today that BYD is kind of emerging globally as one of the EV leaders over Tesla, for example.
Yeah, I think that's fundamentally come back to the question. What the point we made is that why this Chinese EV drive is a structural, is a long-term thing, because it's not because Chinese automakers want to manufacture EVs. It's because in the very upstream we added 70% new power generation capacity, which is make China become an electricity-rich country. So all the manufacturing in the downstream all of a sudden realized that electricity is Chinese new competitive edge compared to cheap labor in the past. So that's why this Chinese EV drive, or whatever is going to consume more power to produce, that will be the Chinese new manufacturing trend.
That's great. And so just to start wrapping it up, any kind of key themes that you think that kind of our listeners should be on the lookout for in the coming couple of years, key trends or big themes that you think will be emerging?
For me, the biggest one is certainly resource competition. commodity reporting markets that may become more illiquid because of it. So just talking just now about EVs and the energy transition. Previously, a lot of people had expectations of shortages of copper and other key inputs just based on the energy transition. Now we have to add in, say, like rearmament in Europe, we have to add in, supply chain security and commodity reporting, for the name of national security in other major economies. And so I think that even is incremental to the demand that was expected from the energy transition. So I think, supply is going to be constrained, markets may become less liquid because supply is going to be taken off markets and put in warehouses or bunkers or wherever. But so I think that's going to be the biggest theme going forward for me.
For me, really, I think what will be really interesting is Hong Kong's ambition to become a major regional hub for commodity trading and warehouse. We had a conversation with some of our friends and clients in Hong Kong, and we have learned that Hong Kong is making tremendous efforts to become a major regional commodity trading hub. This is not only Hong Kong's own ambition. I think this also fits into China's ambition for natural resources, security, nationalism, also to maintain its competitive edge in the energy sector.
That sounds great. Well, that was all the questions that I had for you today. So William and Song, thank you very much for joining us here at the Assay.
Thank you.